the pleasure of welcoming you to the second in a series of 3 pension events. This one, based on customer feedback, we're going to focus on life events. More specifically, we're going to focus on what happens or what a beneficiary can do if they should happen to pass away, and what happens to the pension. So, as I say, more specifically focused on tax events and also the remaining beneficiaries, how they can benefit from the pension. Our presenter today is Lisa Webster. Lisa has great academic and practical knowledge of the space. Having graduated with an economics degree, Lisa entered the industry in 2003 and spent her time before AJ Bell working for a major SIP and SaaS provider. And having joined the firm in 2014, Lisa really is part of the technical team and responsible for providing regulatory and technical analysis to the business, as well as speaking to the media and to our customers as well. So, as I say, a great balance of academic knowledge and practical knowledge as well. In terms of the format today, Lisa's presentation will be around about 20 to 25 minutes, and then we will turn to questions. We've already received several questions, so thank you very much for sending those through. But for those of you that do want to pose further questions, within the registration, within the box that you can see that holds all the information for the event, you'll see a box that's labeled questions. If you just type it in there, type it at any time, I will hold the questions to the end, and then we'll spend probably about 15 to 20 minutes for questions as well. So with that, I'll hand over to Lisa and look forward to speaking to you at the end to answer your questions. Lisa, over to you.
So thank you for joining us, and thank you, Cully, for that introduction. Before we get started talking about today's topic, which is life events and sort of the impact it has on your pensions, just need to be clear that we don't offer advice. I'm not a financial advisor, so please don't take anything that I say in the next sort of 20 minutes, 25 minutes or so as advice. The idea really of the session is to give you information that help you, with your decisions, give you a few things to think about. But if you're not sure about anything, then we would recommend you do consult a suitably qualified financial advisor who can then give you information about your individual circumstances, because obviously everybody is a little bit different. So yeah, we're just here to give you the facts really, and obviously rules on everything I'm talking about today is current and correct as of today, but we know that things in life and tax and pensions can change and rules can change over time. So again, obviously one to bear in mind, but you can only ever plan for what the current rules are, but with in the back of your mind that it might not always be that way in the future. So getting on then to life events. Well, what am I talking about? What do I mean by that? What are we talking about? Things that might happen in your lifetime which may impact how you think about your pension and pension planning, and some things that you should need to put in place maybe at different stages. First one we're going to look at is weddings, if you get married, civil partnership, but also if you just have a long-term partner, not necessarily married, then that might have an impact on sort of how you might want to start thinking a bit more holistically, sort of between you as a couple, how you plan your finances and your pensions. Obviously, another big impact could be if you do have children, and thinking about their future and planning for them as well. Fortunately, not all relationships last the distance, and so we'll have a little look at divorce as well, the impact that can have on your pension and pension planning. And then the final one, which is the one we're going to spend most time talking about, I'm going to spend most time looking at, will be death benefits, because obviously the other 3 may or may not happen in our lifetime, but that one is going to get us all, unfortunately. So by putting things in place and sort of thinking about it in advance, we can make things easier for those that we leave behind. So starting off with then, paying into other people's pensions. So one really, say you think about an obvious point in time would be if you do get married, have a civil partnership, but also if you have a long-term relationship, you might want to start thinking about the fact that you can use your partner's pension, and which uses their own allowances, not just your own. So that's going to be particularly relevant for people who have used up all their own allowances. So you have an annual allowance, which is the amount you can put into your pension each year. and get tax relief on it. If you are a very high earner, that is tapered. My colleague Charlene talked a bit more about that one in the first in our webinar series a couple of weeks ago. So if you're impacted by that, you might be a bit quite restricted in terms of what you can put into your pension. So once you've used up your own allowances, you may want to start thinking about using up your spouse or partner's allowances if they've not already used them all themselves. It can also be, you know, if you're approaching the lifetime allowance, which again is the next one in our series that Tom's going to be talking about in a couple of weeks. But if you have lifetime allowance issues, and so you think you're max funded in your pension, but your partner hasn't, again, that might be a reason why you might want to pay into their pension rather than your own at that point in time. So the important thing to remember if you are looking at paying into someone else's pension is that effectively, even though you're paying it in, it counts as if they've made the contribution, they've paid into it themselves. So it uses their available annual allowance. The maximum contributions that can go into it for personal contributions will be 100% of whatever their UK relevant earnings are in the tax year, or £3,600. So even if you have a non-working spouse, then that you could still pay in up to £3,600 is the gross figure. So you'd actually pay in 2,880 into their pension, and they would get basic rate tax relief on it. On that as well, so you can have a bit of a tax boost going into pensions in their names. So that's one to think about. You can also use the same thing actually for children. It's probably one that doesn't immediately spring to mind. When you think of children and investing for children, your first thing you probably think of is going to be a junior ISA, and that's probably quite rightly so, because a junior ISA, you can access it when they're 18, they can have it. Whereas this is still a pension, so if you pay into a pension for a child, they're still not going to be able to access it until they reach pension age, which at the moment is 55, but we already know that's going up to 57. And of course, with a child, because the long time period we're talking about is quite likely will actually be older by the time they get there. But again, you know, you can do, and quite often this is one that people do for grandchildren as well, it can be. But children can have pensions if you want to start them off early on, give them a good start. So, you know, maybe when they're sort of reaching adulthood, they're probably more focused on saving for a house and things like that. But, you know, they've actually got some pension savings already. So you can pay in for a child. Now, as a parent or legal guardian would look after that and manage all the investments and do all the applications, look after it all until they reach the age of 18. And when they could take it over themselves, but that's another one to think about. Flip side of the, you know, making new relationships, obviously, say if things don't work out, we could be looking at divorce. And then it's really important to consider what pension savings you have and how they should be split when there is a divorce. This is particularly relevant at the moment because we have had a change in the law this year in England and Wales. So it's now actually easier to get divorced because we have no fault divorce now, which came in from April this year. So it's easy for pensions to be overlooked because it's easier to do your own DIY divorce. And so we think there's an increased risk of people overlooking their pensions when it comes to divorce. But in a lot of relationships, it's going to be probably the second biggest asset that the couple have after the house normally. You know, sometimes it might be more than the house, you know, or whatever, it's not always the same, but yeah, it's normally one of the big ones that's up there. And so there's different ways you can treat it. The first way you can do it, in a lot of ways, is the most straightforward, which is offsetting. So, you know, basically, if you have other assets, you know, be it the house, you know, you might say, well, one party takes the house and one party takes the pension, or, you know, splitting other assets, just offsetting the value against each other. But that's not always possible. And it can be very, you know, valuations aren't always straightforward. If you have a SIP, then you can see what the monetary value of that SIP is very easily. If you have a different kind of pension scheme, if you have a final salary pension scheme, for example, that's an obvious one where the value of it isn't as obvious. You can apply and get what's called a cash equivalent transfer value, which is basically if you transferred it out, this is how much you'd get. But what you can actually buy with that in a SIP, for example, or the personal pension isn't actually the same amount of benefits that you could have if you left it in that final salary scheme where it's got all the guarantees and things. So it may have a different value. There's also, you know, if somebody is getting divorced at 60, then obviously you can access your pension straight away if you need it for the income. But if you're getting divorced at, you know, 35 or 40, you've still got a long time before you can actually access the pension. So, you know, if you need something to live on today, having, you know, giving somebody offsetting, so somebody gets the whole pension, somebody gets the rest of the assets, that doesn't really work for helping people, you know, survive day to day. So it's quite, yeah, it can be quite complicated. So it is certainly an area that, you know, it may be worth considering again, getting some advice on if you are getting divorced, especially if you've got sort of final salary pensions, different kinds of pensions, because it's quite a complicated area. So, you know, if you can't do offsetting, it's not always easy to do, it's not always appropriate. There's an old way of doing it called earmarking, which it still exists, wouldn't really recommend in most circumstances that this would be appropriate, because an earmarking on a pension is where the original member that holds the pension, you keep the pension, but when you come to take benefits, a certain percentage of it is earmarked and goes directly to your ex-spouse, which kind of used to work when everybody used to have to buy an annuity or you had a scheme pension from a final salary scheme. But in the days now we are of pension freedoms, where you never actually have to access your benefits, or you can just take a little bit here and when you want. It doesn't really work, because the member that holds the pension, they get to choose when the income is taken, and the ex-spouse, yes, they get some of it when they choose to take it, but they may never choose to take it, and they may never get it, and they have no control at all. So it doesn't really work anymore in today's pension world. So the way most pensions are split and dealt with these days is by a pension sharing order, which allows you to have a clean break of the pension. So basically there will be a percentage of the pension that's awarded to the ex-spouse. Now, if you agree it between you, then it's a consent order, and that just gets rubber stamped by the court. If you agree it between yourselves, if it's all amicable, they'll rubber stamp it from the courts, and then a percentage of the fund is a pension debit on your pension, and then a pension credit, corresponding pension credit, which is for the ex-spouse, and they can then take it, transfer it to a pension of their choosing, and do whatever they want with it. So they have complete control. If you don't agree, then it's just a financial order, because basically the court will look at everything and they will decide what the appropriate split is if you can't agree amicably yourselves on that. But there's lots of things to consider with it. It's not a straightforward just monetary value against monetary value. So different issues about accessibility. You know, if one of you is a higher rate taxpayer, one's a basic rate taxpayer, it's worth a different amount in people's hands. You know, about age that you can access it. You know, different kinds of pensions might have different death benefits, guarantees, things like that. So it is quite a complex area, but it's a really important one that to consider. You know, if you do get divorced, that the pensions are considered properly. Moving on then, I'm going to spend the rest of the session just talking about death benefits then. So first thing to look at is what happens to your pension when you die. So when we, as the pension scheme administrator, provider, we get informed that one of our members has died, we then have to exercise our discretion to decide where those death benefits should be paid to, who should have them. So what we do on that, there's certain bits of information we look at. First and foremost, we will look at who you have nominated. So when you set up a SIP with us, as part of the application process, you have to say who you want your SIP to go to, your death benefits to go to. But your best customers, you can just go online at any point in time. You can log into your account and you can change your SIP beneficiaries if you need to update them. You know, that's fine. You go along there. So that's the first thing that we will always look at. But it's not the only thing that we consider, because we can have nominations that people have made which are really, really out of date, because people have forgotten to update them as their circumstances change. Now, I would really please everybody to make sure you do. If your circumstances change, it makes life a lot easier. it's not only less work for us, but then it's less time, and we don't have to keep going back to your the people you've left behind, to your executors, to your family, trying to get information and trying to find out what's happened. If it's the more up to date it is, the easier it is. It means basically that your estate, that your death benefits, I should say, not in your pension, could be dealt with a lot quicker. The more up to date it is. But we will consider things like, obviously, if you've got married since you last updated your nominations, if you got divorced, and we will also look at the will and see, what are the parties there are, if it kind of ties up with the will, and if it's been done at a similar time, things like that. We'll take this all into account. The reason we exercise discretion is because by exercising discretion, obviously, one is the fact that, if circumstances have changed, we're not bound to pay it to, your ex-spouse who you divorced 10 years ago and paid out a pension sharing order to, and then you've remarried since, but you've still got your ex-spouse on the beneficiary. We're not bound to pay it to them. We could take that into account. But most importantly, it keeps the pension outside of your estate, so it's not subject to inheritance tax. So that's the big one, really, why we have discretion, because if it was a binding nomination, that wouldn't be the case. So in terms of your beneficiaries, there's 3 different types of beneficiaries. Now, the first one of these will be a dependent, and this is HMRC give a definition of what a dependent is, and it's whether somebody is a dependent on you or not is a matter of fact. It's not, sort of a question of whether you think they are or not. So automatically, any spouse or civil partner will be a dependent on you. Any child you have under the age of 23 or older child if they're physically or mentally impaired. Somebody who's financially dependent on the member, that's the one I suppose is a little bit more subjective, because we would have to find evidence that somebody was financially dependent on you. But for example, it might be somebody like your partner's child or something, though you're not actually married, it's not your stepchild, but it is, you might have been in a long relationship with their parent. They might, be financially dependent. You might be supporting them for most of their life, something like that. But it's not actually your child. That is just one example of where somebody could be financially dependent on a member. Could be a partner. Somebody who's in a financial relationship of mutual dependence. That's most commonly would be if you had a common law partner, so somebody you've lived with, a long-term partner, maybe, but you're not actually married or in a civil partnership. That they could be, if you have joint finances, you have a joint mortgage, all the bills are in joint names, and you do everything together, and you are mutually dependent on each other, then they could be classed as a dependent. Obviously, for those who say, when we're looking at the process to determine if they were a dependent, we would have to, we would need evidence to back that up, whether it's a spouse or a civil partner. We just have to ask for a copy of the marriage certificate. That's quite straightforward on that. So a dependent, I say, we will always consider a dependent. So anybody that we find to be a dependent, whether you have nominated them or not, we will always consider them. It doesn't mean we'll always pay them benefits, pay your death benefits to them, but we have to take them into consideration, anybody that's dependent on you, when we are exercising our discretion. A nominee then is basically anybody else that you nominate after your death to receive your benefits, who's not a dependent. So it could be, most obviously would be an older child. You might have a 30-year-old child or something like that. That's absolutely fine. They're not dependent on you anymore. You can still nominate them. That's fine. You don't have to say as well when you fill in your form whether they are a dependent or not, because it's just a matter of fact. At the time, we would ascertain whether they were a dependent or not. But yeah, you can name whoever you want. So it's really flexible. You can leave your pension to whoever you want, and we will consider them. Successor is just kind of one a bit further down the line. The death benefit rules now for passing on pensions are very generous. So you can leave your pension to whoever you like. So for example, if you left it to your spouse, but they didn't use it all in their lifetime and it was still in a pension, on their death, they can nominate somebody to pass it on again, which might be one of your children. They would be classed as a successor because it's still your original pension fund that got passed on to your spouse, and then it got passed on again. So it's not the spouse's own pension savings, then that would be classed as a successor. But I say it can be anybody. It doesn't have to be family members. When it gets to nominees and successors, it could be, a close family friend, things like that. that's absolutely fine on that. Just one thing I would say, with dependents, say we always have to consider dependents, but if you have a dependent, but they are of, their own, financially secure, they don't need it, you want to pass it on to your adult children rather than to your spouse, you can do that. That's absolutely fine as well. It just means we have to consider them. So we want to know that they were financially secure before we didn't include them in the distribution of your death benefits. So what can be paid then? So once we as scheme administrator have exercised our discretion and said, right, this is who's going to be allocated your death benefits, they can then choose how they take it. So they can choose to take it all out of your pension fund in one go as a lump sum, that's fine. Or, this is probably a bit more common these days, is that they can put it into a pension in their own name. So they can draw income from that as and when required. Now, the advantage of that is, of course, the pension is a tax wrapper. So they can keep it within a tax wrapper and all the tax advantages, so no CGT or income tax to pay on the investments within that wrapper. And then they can just take the income at any time that they want to, as and when they need it on that. Or they can do a combination of the two, so they can take a bit of it as a lump sum, a bit of it as drawdown. That's absolutely fine. So it is really flexible. We don't have to pay benefits just to one person. It can be split, if you want to leave it to your 3 children and split it equally between them, that's absolutely fine as well. Also, lump sums can be paid to trusts or to charity. I'll talk a little bit more about charity in just a moment. But yeah, there are options as well. And it doesn't happen that often, but there are circumstances where somebody who's not a dependent or a nominee, if it's appropriate to pay death benefits to them, they can have it. They would be able to have it as a lump sum, but not as a pension. But it doesn't really happen, too often. And the message really is, make sure your nominations are up to date, and then we should never get to that point on that. So if your beneficiaries choose to take it as drawdown, so they choose to leave it in the pension, they can take income from that whenever they want. So, if they don't need the income now, they can leave it untouched in a pension for, 10 years, 15 years, whatever it is. There's no need for them to access it immediately. They just need to move it into the pension in their own name following your death. But once it's there, there's no time limit on it. And it is at any age. So it's not, because it's not their own pension. I think the screen just flicked again. Sorry about that. Because it is their own pension, they can access it at any time. Let me just get the right screen back up for you. So they can take it at any time, which means they don't have to wait until they're 55. So if you do have, let's say, adult children, they can take it whenever they want. So they could take it, when they're 30 or something. That's absolutely fine. Or if you wanted to go to the extreme example of, having a junior SIP, you could even leave it to a child. The parents would look after it, but then you can still actually make withdrawals for the child, as long as it's for their benefit, for things like paying school fees is an obvious example on that. They can have it, if they already have their own pension, they can transfer what was your pension into their own pension, so in one SIP, but you just have them the separate pots. They have their own pot, and then they have the pot which is what's called their beneficiaries pot, which is basically what's come from your death benefits. And if you take income as a beneficiary, it doesn't restrict what you can save into your own pension. Some of you may be aware of the rules around pension flexibility, where you start taking an income from your pension. It restricts how much money you can pay back you can save into a pension each year and get tax relief on. If you take income from a beneficiary's pension, it doesn't have any impact on that. So that's good news. Tax treatment then. So if you die before the age of 75 and your pension is moved to a pension in your beneficiary's name or paid out within 2 years, then the good news is it's pretty much tax-free. The only caveat on that is that in some circumstances it will be subject to a lifetime allowance test. So if you've accessed benefits in your lifetime and you've what we call fully crystallized your benefits, so you've said you're going to take drawdown from it, if you've done that in your lifetime, then it doesn't get tested again. It only gets tested on your death against the lifetime allowance if it's not been tested previously. So if you haven't had a lifetime allowance test in your lifetime, when you die, there will be a test on those benefits then. So that's the only tax that could be payable on it if you die before 75 and you pass it on to your beneficiaries, as long as they move it from your pension, either take it as a lump sum within 2 years, or they put it into a pension in their own name within the 2-year window. If you die over the age of 75, then any income or the lump sum taken by your beneficiaries will be subject to income tax. So if they take it out as a lump sum, then it'll be all subject to income tax in that year. It's not always, particularly if it's a big sum, not always the best idea. But if they put it into a pension in their own name, again, it can sit there for years. It's just whenever they choose to draw income from it, they would pay income tax on those withdrawals. If you pay it across to a trust and you die over the age of 75, then there is 45% tax deducted when it goes from your pension into that trust. There is a corresponding tax credit that you can get when payments come out of the trust afterwards, but that's probably a little bit more complicated than we've got time for today. But there's no lifetime allowance test if you die over 75 on your death benefits, and that's because even if you haven't accessed your pension, they are all tested against the lifetime allowance on your 75th birthday anyway, so everything will have been tested before you die, so there's no test again on death if you die over the age of 75. Okay, final thing I'm just going to touch on is about charity lump sum death benefits. So, if you have money in your pension and you either don't have any dependents, or your dependents are well catered for, they have enough income of their own, they're financially sound, then you may want to consider leaving money to a charity. Now, to qualify as a charity lump sum death benefit, it can only be paid if you don't have any dependents, because we have to first consider dependents. So, if you have got dependents, if you've got a spouse who's independently wealthy and you want to leave money to charity, what you might do is actually leave it to your spouse, and then on the second death they leave it to the charity, possibly, because I say whilst you still have a dependent, you can't actually have a charity lump sum death benefit from a pension. It can be paid, it can only be paid to a charity nominated by you. So what we mean by that is that you can't say you want it to go to charity and then but not specify the charity and then your family decide, or even if you said you want to leave it to somebody else and they say, I actually don't want it, I want it to go to charity, they can't nominate that charity, it has to come from you, so you have to express that in your lifetime. But the good news on it, there's no lifetime allowance test. So if you died before 75, the advantage of this because benefits paid out before 75 are tax-free normally anyway, but the advantage of this, it being classed as a charity lump sum death benefit, is that there is no lifetime allowance test on it. If you die over 75, your benefits will already have been tested against the lifetime allowance because on your 75th birthday. But the advantage of this, the charity lump sum death benefit post 75, is it can go to the charity completely tax-free. Whereas if it went to any other of your beneficiaries, it would be taxed when they come to take the income, when they came to take it.
Thank you very much for that, and also being nimble enough to deal with the technical issues. That's very admirable. So we've got a lot of questions. We have hundreds and hundreds of customers attending. So I've tried to lump them together wherever possible. We're going to spend about 15 minutes on questions, just so everybody knows. So let me start at the top. Can I give it, and we've still got a lot of questions coming through, so I'll try and cover as many as we can. First question, can I give instructions as to how my beneficiaries use my pension after my death? And linked to that, what happens on death to a defined benefit pension, if you're able to answer that?
Okay,
so
the first one then, can you define what happens? I think the short answer is no. Your nomination, you can only say who's going to get it, who you want to have it. You can't control how they take their benefits. Now, this is when we do get asked a little bit, because sometimes you might want to look after somebody, you want to make sure they're provided for, but maybe for whatever issue, they're young, maybe they're just whatever it might be, you don't necessarily want them to have access to a huge lump sum that they can just take and blow.
Right.
Now, within the pension, there isn't a way you can control that. So the only sort of caveat is maybe if they're under 18, yes, you can leave it in because a parent legal guardian would have to look after it until they reached 18. But for anybody over the age of 18, then the only way round that is you could use a trust. It's why you might still want to consider making a payment to a trust rather than leaving it directly into a pension, because if you had your death benefits, if you nominated a trust, then you could nominate the trustees who are responsible for it and give them clear instructions about, you know, what you want the beneficiary to be able to do with it, and you can exercise a lot more control that way. Now, if you die before the age of 75, then it can go from the pension, as long as it's done within 2 years, tax-free, into that trust. There are some periodic charges involved with trust. They're just standard trust charges that may apply that you need to consider. This is more if you're over 75 when you die, because you have this 45% deduction when it goes into the trust, which is say there is a tax in it when money's paid out, but if the money's sat in there for a long time, you've lost out on the growth on that 45% that's missing. So it's a bit more of a complicated decision. And again, it is a complicated decision where it'd probably be worth taking some advice on that around trusts and things. But the short answer to the question is no, you can't control it within a pension, I'm afraid. Second one, I think, was about DB, wasn't it?
DB, that's right, defined benefit, that's right.
Final salary or defined pension schemes. Usually it will depend on the scheme. I'm not claiming to be an expert on final salary schemes either, because it's not really our field. We don't deal with them directly. But normally they will provide a dependents pension, possibly a lump sum, but that's about it usually. Quite often with the scheme, it'll only be provided. Yeah, so if you don't have a dependent, the pension might die with you. And yeah, dependence, it might be a 50% or a 2/3 or whatever. It'll depend on the scheme, really. So
I guess the key is making sure you've assigned a beneficiary if anything should happen to you.
But yeah, generally speaking, it's normally only to a spouse or a dependent.
Right. We've had lots of questions about transferring pension pots to spouses in lots of different ways. One question is, can part of a pension pot be transferred to a spouse in any other case than divorce?
Divorce or death, that's about it, really. Yeah, you know, not without withdrawing and paying in, but all tax implications. Obviously, you have to be old enough for pensions and everything else. No, it would be an unauthorised payment. You can't assigning pension benefits to somebody else other than on death or divorce would be an unauthorised payment. So the short answer on that is no.
Okay, and sticking to the spousal question, because as I say, we've had several questions in that area. The next one is, if I leave my pension to my wife and she decides she doesn't need it, can she say she doesn't want it and it goes straight to our children? So is that possible to sort of skip spouse?
That's not an uncommon scenario. So yes, is the short answer. Now with that, the best way to ensure that happens really would be to you know, drop your provider, just drop us, you know, on our you can nominate your beneficiaries, obviously you can do it online, but if you want to give us more information, just drop an email, we keep it on file, and just say, look, I want you to see my spouse, but if she doesn't want it, then send it to my kids, that's fine. We do have circumstances where we've not had that instruction, but when it comes to it, you know, and the spouse will turn around and say, so they say if the husband's died already, the wife might turn around and go, well, actually, I don't want it. Can you give it directly to the children, even if he hasn't said that to us beforehand? And if everybody's in agreement with it, then yes, we'll normally do that. That's fine. But obviously, if you can put it in writing and tell us beforehand that, you know, spouse, if she wants it, and if she doesn't pay it to my children, just tell us that. Any information like that. But yes, that can be done. Yeah,
great. That's good to know. We've had lots of questions about the age of 75, Lisa. One question was, will you cover the age 75 lifetime event, lifetime allowance estimation, and lots of different versions of that? Why is 75 important as it relates to pensions? So
age 75, I think, is it goes back to the old days when you had to buy an annuity, you had to do it by age 75, whereas it's all gone out the window now. But the thing about age 75 is still, yes, you have a lifetime allowance test. So even if you haven't touched your pension because you don't need it, you've got other sources of income, then you can't avoid a lifetime allowance test. By you hit your 70th birthday, you have this test. I'm not going to go into lots of detail about the lifetime allowance test now, because I think this is what Tom is covering. We have another webinar in 2 weeks' time. My colleague Tom Selby is looking at lifetime allowance and lifetime allowance issues. So you could talk for a long time about lifetime allowance and age 75 tests and things like that. But I think Tom's going to cover it in a couple of weeks. So it's probably one to keep for then, I think.
Yeah, we've had lots of questions around lifetime allowance, around the 75, or just generally as well. So as Lisa said, please do come along in a couple of weeks.
I suppose, yeah, the other thing, sorry, just is for the death benefits, but relating it back to this is yes, you have this lifetime allowance test, but then it makes a difference to whether you're taxed, whether your beneficiaries are taxed or not. Taking income is after age 75 as well. So yeah, it does make a big difference.
Okay, great. So I'm just looking through the rest of the questions so we can bunch them together. Can you have beneficiaries not resident in the UK?
Technically, the answer is yes. Practically, there can be some issues with that. I know it's how you actually make payments to overseas bank accounts and things like that. Money laundering. I think if it's a one-off payment, it's normally fine. If it's a regular income, then it could potentially be more of an issue. If you can see, if the once we decide on the beneficiary, if they are overseas, they can choose where they put their pension. So it may be, I'm sure there will be pension providers that will facilitate it if they wanted to keep it within a pension, but you may be restricted in your choice because not all pension providers certainly will do that. But yeah, certainly they could take it as a lump sum still. That would definitely be still be an option. But there's no technical reason why they can't be overseas, but there are practical reasons of just banking and money laundering and things like that, which make it a bit more complicated.
Yeah, great, thank you. We've had lots of questions about annual allowance as it relates to children's SIPs, but we'll cover that with Tom in a couple of weeks. I'll make sure I feed that back to him. It's a big area of questions. Another question away from that, Lisa, is the 25% tax-free cash element available to a dependent, nominee, or successor?
No. Is the short answer on that one. So yeah, your 25% pension commensurate lump sum or tax-free cash is only for you as the member. If you haven't taken it, if you haven't accessed your pension before you die, then no, your beneficiaries can't take it. But well, if you die before 75, your beneficiaries can have the whole pension tax-free, not just 25% of it. But if you die over 75 and you haven't taken your tax-free lump sum, then no, they don't get any element of it tax-free.
Okay, great. I'm just looking through the rest. I'm receiving both a workplace pension and a state pension. What happens to those if I die? I am married. Okay.
So your workplace pension, if it's a personal pension, then it'll be like the rules I've talked about today. If it's final salary pension, because a workplace pension could be either, then it'll depend a bit on the scheme, but it may be. But yeah, it would certainly, you would normally expect it would at least provide food for your wife. That would be fine. State pension is normally yours. I'm just trying to think that there are some circumstances in the past where people could inherit, and it was always wives inheriting their husband's state pension records if they've got gaps in their own records. But basically, that aside, your state pension is your own, and that's it. So she wouldn't get anything on that. Apart from, I'm not claiming to be an expert on state pensions.
Okay, great. So I'm just looking through the rest to make sure they're relevant. Death before 75. I nominated my partner to receive my SIP on my death a couple of years ago. I asked the statement, designated to your beneficiaries within 2 years, they will be paid tax-free. Can you explain what this means, please? Can we read that again, Lisa? Are you okay?
Well, you can correct me if I'm wrong. So somebody who nominated their partner, if they die before 75, yeah, as long as they will receive the death benefits tax-free, as long as, first of all, your death is before 75, but secondly, they have to, when we talk about designating the funds to draw down. What that actually means is it just has to go from being in your pension scheme in your name, it has to be moved into a pension in their own name within 2 years for it to be tax-free. If it takes longer than 2 years, which normally that only happens in cases on death benefit cases, is where if you can't trace people, or people aren't coming back to us with the information that we've required when we're writing to people, they're just not replying to us, things like that, then they can drag on over 2 years. But if it's straightforward, we've got a nomination, we have the contact details, and people come back to us, as long as we can do it within 2 years, and then it gets transferred into a pension in their own name within 2 years, then they can leave it there as long as they like, untouched, or they can take it straight away, whatever they want. Then it'll be tax-free for them. It's just the fact to move. The designation just means moving from the deceased person's name into the beneficiary's name, into a pension in their own right.
Okay, great. We've had a lot of questions around DB pensions, defined benefits. As Lisa mentioned, that's not really our area. We deal with defined contribution. I would encourage you to reach out to whoever is administering your pension if you have specific questions related to DB. So I'm sorry we're unable to answer those. So we'll go to one more question, Lisa. If a SIP is inherited and then included in one's own SIP, how does this affect the LTA? So I know it covers sort of both areas.
Yeah, no, that's fine. No, it's a good question, actually. So if there is a lifetime allowance test or death benefits, to say it's not been tested in the member's lifetime, it's always tested against the deceased's lifetime allowance, not the person who's the beneficiary. And once it goes into the beneficiary, and so they can have the beneficiary's pot and then their own pot as the member, when they come to take benefits, it's only their member benefits that are ever tested against the lifetime allowance. The fact they've got beneficiaries benefits, I always say it doesn't impact their lifetime allowance. There's just one horrible little quirk in the rules, because there's always something horrible and quirky, is if you have a form of enhanced or fixed protection, as long as you move your beneficiary's pension into a pension you already have, you're fine. But if you were to set up a new pension scheme to receive those benefits, then you could break your protection, and that's the only impact it would have on your lifetime allowance. But anybody who doesn't have protection, you don't have to worry about that. The general answer from the vast majority of people is it doesn't impact your own lifetime allowance.
Right, fantastic. Great. Well, Lisa, thank you very much for answering those questions on the fly. And to everybody, I hope you very much enjoyed Lisa's expertise. Lisa mentioned that this, or as I mentioned as well, this is the second of 3 events. The third one is with Tom Selby coming up in 2 weeks' time. I know we've got lots of questions on LTA, lifetime allowance. So I encourage you to come along to that event. We had some questions of whether the recording would be posted on our site. It will be. And we'll send a link as to where that will be. Lots more resources available on the website as well around our pensions tab. And finally, some of our colleagues will reach out to you as well to understand how we can continue to help you with your investing needs. So with that, I will thank you all for attending. And again, Lisa, thank you very much for your expertise and sharing.
No problem. Thank you everybody for your time.
Thank you. Bye-bye, everyone.